Ashley Burtenshaw, Gryphon Capital Investments, thank you very much for participating in Investment Leaders Forum New Zealand.
Thank you, James, for having me.
Pleasure to have you here. Ashley, how does flexibility in managing fixed income portfolios, particularly in terms of sector allocation and credit rating adjustments, both protect against the downside and give the portfolio more resilience?
James, what we refer to is predictability, right? And so across a risk-off or a risk-on environment, predictability is number one. So in sector allocations, we'll be looking at prime and borrowers and, basically overweighting the portfolio for the prime borrowers. And then for those more unpredictable payers like non-conforming or self-employed borrowers, we would tend to be underweight those borrowers just because of the actual difference in terms of how the borrower performs in the different scenarios. In terms of rating, it really is an interesting question because as the rating changes or the potential to change, so on the fear of a downgrade, you could actually lose material money. And then also on the way of an upgrade, you can actually make material money. And so what we'd be looking at in the environment of a risk-off environment was what's the ability for that rating to stay the same? And in a risk-on environment, what we'd be looking at would be what's the probability of that rating being upgraded? And it's particularly sensitive in the below investment grade buckets.
Can you elaborate on the role of active management in fixed income markets and how these requirements help in terms of avoiding the downside for investors?
So what we look at active is we're looking at searching for what's the right risk. And we use, this expression called sourcing alpha. And getting access to the right risk for the right environment is critical. And so what we look for there is the breadth of our originations and designing the right type of investments for our portfolios. We also look at controlling spread duration. So the longer you're out, the more uncertain it is, and the shorter it is, the more certain you are. So we look at controlling the spread duration. And then lastly, what we also look for is the rating, making sure that there's significant, margin of safety in the ratings to actually protect if there's any volatility in the markets.
A lot of your work involves data-driven decision-making. So what does that process look like in practice?
It's a database roughly around about 9 million data points updated every month across 250,000 loans. So to put that in perspective, it's about a $38 billion notional portfolio, which would represent approximately 2% of the mortgage system in Australia. So what we do is we take that data, we stratify the data, we produce stratified reports. We also produce, stress losses off that data as well. And then for the rest of the team, what we're looking to do is extract what we would see as being the loss-adjusted yield available on those portfolios, given the amount of data that we've got.
What are the really key metrics or indicators that you prioritise in both capturing or the data capture piece and then the analysis piece?
So the leverage is important. So the loan to value is number one because that builds the alignment. We look at how long they've been paying for, so what we call the loan seasoning element, and what that entails is predictability. And if you think about the longer they pay, the better they get. We also look at the WACC, or what we call as the mortgage rate, because it tells us a lot about the borrower, who wants a high mortgage rate, who wants a low mortgage rate, who gets access to that. And then probably finally, just the extent of the documentation that goes into underwriting that borrower.
Across this wonderful event, Ashley, we've heard so many views on markets, but also around framing those themes for advised clients. What have been your key takeaways from the Investment Leaders Forum?
I really enjoyed the recent panel session with Richard from Brandywine Global, and just his take on the negative correlation between bonds and equities, and then also his view on where long-term bonds are going to be trading in a world that's very uncertain and very volatile. So I did really enjoy that session.
Ashley Burtenshaw, Gryphon Capital Investments, thank you very much.
Thanks, James.